When you look at recycling or just general ESG investments, you touched on some of the criteria. Do you have a target hurdle rate or payback period that you also look for in this play? Because that's always a question on ESG is what's the bigger hurdle rate?
So for us, we're equally focused on financial returns and GHG emission reduction profile. So in terms of the latter, we're looking for a 60% reduction in emissions versus the incumbent at a minimum. Say our portfolio is typically closer to 80 to 90%. In terms of payback periods, I'd say 3 to 4 years is what we're generally looking for, but I think it varies based on the space.
More questions?
Question about just on the plastic recycling side, one of the key issues is volatility around pricing, which everyone's been feeling. And the traditional virgin, it's a lot more about feedstocks, which are more volatile versus a lot of fixed costs in a recycler. Have you seen any strategies that and I've struggled with this, but have you seen any strategies which sort of are able to reduce that and create more fixed, on input or output? Any strategies around that you've seen successful?
I'll give a good example, and it's the synthetic lumber manufacturer. The strategy we've seen most effective is sort of treating the extrusion center almost as if it's a refinery, and we're optimizing feedstock based on delivered price. And so by that I mean there's certain baseload feedstock we're always going to take. In our case, and it's also a separate sort of recycling strategy, we send truckloads of our base material to folks who make everything from outdoor chairs to picnic tables to picnic benches, those kinds of things out of it, but they generate 20 to 30% scrap. It used to be the case that we didn't have last mile distribution, so they were treating that as a waste product, selling it for 5 cents a pound. And for us, this was, HDPE that we'd already added all of our additives to and colored, so it was worth 70 cents a pound to us. So we said there's clearly an economic answer here. Well, if we invest in last mile distribution to support actually getting them product, we can also do milk run collections, pay them 20 or 30 cents a pound, so they're not paying some guy 5 cents, and bring that back and displace what otherwise would be wide spec or post-industrial or post-consumer out of our recycling operation. So one example, okay, well, let's get that base load going. And then the other strategy was sort of a variety of the other inputs I mentioned, which is being able to jump into and out of those different markets, post-industrial, wide spec, and true post-industrial, meaning excess or discarded bottle caps from the big bottlers out there. So it doesn't sound that exciting, but it's just having a really scrappy and fairly beefed out procurement and supply chain operation where you're actually able to operation on a day-to-day basis, participate in all these different markets, while at the same time is delivering what the extrusion business needs, which, they sort of don't care about all that. They just want resin availability and never to run out and have it hit a certain set of specs. We did have to, as part of that, widen that spec. That then made it more challenging operationally to figure out how to run those kind of varying degrees and invest in things like large blending silos. But that's all kind of using variability in terms of different input streams to manage some of that. And then the final thing I'll say is developing a capability in our recycling center to go from it being running full scale to dialed back, and that meant cross-training some of our recycling employees as extrusion operators, such that when recycled HTP prices blew out and made no economic sense for us, we could jump out of the market, but without permanently mothballing it. We could light it up 2 months later to the extent that it made economic sense, which was more challenging than we originally thought to be able to kind of develop that muscle.
Yeah, fixed cost burden of recycling facilities is a big challenge. I think what we have focused on in order to deal with that is making sure, it's very obvious, but making sure your output is the very highest percentage of on-spec, high-priced PCR possible, and reprocessing some of that off-spec material, making sure that all of your yield loss should indeed be waste, and that you're properly properly treating that so that you get as much from each bale you're paying for as possible, and then say debottlenecking the proper places in the process to facilitate both of those things. So definitely an ongoing learning process.
There's a question here.
I'm Kyle Shen with Nexeris. John and Katie, thanks for your insights. As Matt mentioned, our company is spinning out various technologies, and there's different business models we could deploy for these businesses. So my question is, as you look at investments, do you have a bias towards significant short-term profitability, or is it still more about overall value? How important is that short-term profitability to the investments that you look at?
Good question. So, so we're looking at new technologies, new business models. We're very focused on the durability of the earnings and longevity of the customer demand. Typically avoiding commodity price risk. I think it's important to be honest with ourselves about what is exposed to commodity price risk, what are commodities in certain cases. I think it's not always as obvious as when we did initial underwritings. I don't know, is that helpful to your question, or if you give me an example maybe?
I'll give you an answer, which is, I think for us, anytime we bring any plastics-related business to our investment committee, or to our lenders for that matter, the starting point on unit level economics and the stability around them is always looking at gross profit or gross margin on a per pound basis by month over time, mapped against said input and output markets. And if the thing that a lender could see that would make them the happiest, obviously, is something that just looks like a flat line, right? And of course, no one can achieve that, but the question is, how close to that degree of stability do you get? How much of it is a tolling operation like? And of course, if it's a flat line that's going up, it's even better. But I kind of simplify it down to that level because that's ultimately what gets new lenders interested in the space, and Sterling's brought a number of new lenders into the recycling space for the first time. What they are is violently allergic to a lot of volatility. Even if it generates some really massive windfall profit opportunities, it's to the destruction of ultimate value of that business, because what may be a leverageable business and worth 10 times, otherwise the said volatility is worth 5 times using whatever the earnings base is. So that stability of unit level economics is really absolutely critical and hard to achieve given all the dynamics we've been talking about.
In terms of competition for these assets that you guys are investing in, what are you seeing? Are you seeing a lot of interest from strategics, or is it just other funds, or there's not a whole lot of people out there who are looking at this?
Well, I was going to say, I'm smiling only because a bunch of people with a bunch of dry powder just sort of jumped into the space in 2021 when a lot of those unit level economics were blown out to the upside. And they stepped in thinking, oh, this is a great business. We're going to make 80 cents per pound into perpetuity on some PET strapping business, let's say. And that's anyone who has any experience in the space, you're bracing for it to reverse. But I think there are a number of investors who are going to have some pretty, not us, of course, esteemed panelists, but a lot of people who were less experienced in the space, who didn't have that chemical background, who thought they were evaluating a consumer business, but really it was a manufacturer strapped on top of a resin processor, and those economics got really distorted in the last 18 to 24 months. Those have come down to planet Earth to a large extent. So I think that was why I was smiling at your question, because I think there's going to be a lot of that where folks who tiptoed into the space or maybe even dove headfirst in will retreat, which I think ultimately is good for folks like Katie and I who have more experience in the space and familiarity with it.
Yeah, I feel like Carbon Light, those assets had a ton of interest. I looked at them briefly. It was too big for our first fund at the time. But yeah, in Europe, where we have made a bunch of small acquisitions, even for these very small, like 25 million euro revenue businesses, there is quite a lot of interest, especially on the RPET side. LDPE is a bit more manageable, but these family-owned businesses have probably been cobbled together over 20 years, started as a maybe cardboard collection business, then got into film recycling, and need a lot of investment to debottleneck and to upgrade, that they have very, very high value expectations. So I think we've seen quite high competition. I think at this point, with those three mechanical recycling investments, we're really focused on execution of our now organic growth opportunities and focused on strategic supply and offtake relationships.
Okay. I'm double dipping here, so one last call from the floor. Otherwise, I have one last question for you guys. I think the last question is like, who's going to buy these assets when you guys put them on the block, I guess? Who are some likely buyers?
So I think for the 5 investments I've mentioned, we would expect there to be pretty strong interest from strategics. Perhaps those that generate the feedstock that are looking to further integrate.
So those would be companies like Waste Management.
Yeah, Waste Management, for example, bought Avantgarde or Natura PCR. So that's one example. I think like there are very large waste management, lowercase letters companies in Europe that we would expect to be interested in our portfolio. Also, I think financial buyers for these businesses, dependent on the types of contracts we can put in place there, we'd see it as infrastructure-like. So I think
you don't see the chemical, polymer, petrochemical companies in that pool?
I was going to add them to the pool.
Okay. Okay.
Yeah, I think it's a very interesting dynamic there. They're both a buyer of PCR, but also, it's displacing their core business to some extent.
Yeah.
I would just add on there are many larger investment firms than those that Katie and I work at, and they're under tremendous pressure to put,
Of course.
sort of points on the board as it relates to their ESG investments, right? And there's a huge scarcity of scaled, quality, profitable businesses with some degree of recycling as its core capability. So if you serve those up, there's a tremendous amount of investment interest, has been our experience, and strategics, whether they be chemical or waste collection folks, or in the case of our business too, like packaging strategics or building products businesses who are looking to add another product to its portfolio. So.
Okay.